Let me first ask you about the geopolitical risks in the market. We have seen stocks bounce across the Middle East, Asia, and futures are looking good for Europe and the U.S. So it doesn't seem like the market is as concerned post-bombing as it was pre-bombing Wei.
What we have seen in markets is that investors are actually increasingly getting excited about the earnings season getting started in the U.S. And at the end of the day, when we analyze what is the impact of geopolitical development on investors' asset allocation as well as markets, the bottom line question is really very much, is this going to impact growth picture? Is this going to impact earnings outlook? And based on what we have seen so far, year to date, growth upside surprise has been capped somewhat, but still stabilizing at a very high level. And earnings expectation has been turbocharged by greater fiscal spending and tax cut in the U.S. And because of all of that, investors are choosing to look at the boost. And that's why we see kind of markets trending higher last week. But also we're starting to see flows coming back in as well after a reasonably softer start of the year.
Wei Li, I thought of you when I used this chart yesterday. When everybody was having a lovely Sunday in London, we put this together in the library. It's in GTV. It's about the flow of money into equities. Lovely line. You can throw 2% all day, every day at the US equity market. Trump tweets layered on top, but they're not quitting stocks. The flow of money is into stocks. Are you adding money on these dips? Are you seeing a flow of money being added in lump size to equity markets on the drawdowns?
Not to the extent that we saw for most part of last year. And if you think about kind of on a weekly basis, 2017 has been a year rather remarkable in that every single week on a global ETP basis, we have seen inflows. And year to date so far, we have had 3 weeks of aggregate outflows, which says something given the pile of money sitting on the sidelines. So investors are a bit more cautious this time in allocating on the dip because of withdrawing liquidity, because of growth upside being capped, and because of heightened geopolitical headlines. But that is not to say that they're not doing it. They're just a bit more selective this time round. So what we have seen so far is that emerging markets have been a lot more favored as a destination for investors to add risk, probably also supported by a weaker dollar, whereas U.S. equities have actually seen outflows so far this year. And that is something, given that it is 50% of the global equity benchmark.
Do you expect that to continue? I mean, global stock valuations have come down for the developed markets. We're looking at 17 right now for the U.S. S&P. We're looking at 14.5 in Europe, even lower in Asia, less than 14. Does that mean that you find bargains in Asia and Europe when you're looking at developed markets?
Within developed markets, absolutely Japanese equities look more attractive in comparison with the broader benchmark. But when you talk about multiple, when you talk about valuation, we do not expect multiple re-rating to get even more stretched for this year. But stock returns can come from earnings. And so far, earnings upgrades have been very broad-based and have really been quite impressive as well. So if you think about kind of at the beginning of the year, for U.S. equities, earnings EPS growth for this year is in the low teens, and it has since then been steadily upgraded by 7% and higher. So that sort of return still makes stocks more attractive as a place to allocate your portfolio in comparison with credits, in comparison with government bonds.
Wei Li, when we look at the global growth story, I mean, we've got a lot of challenges and headwinds in front of us this week. More sanctions potentially against Russia, discussions between Trump and Abe. Have a look at this. This is in the GTV library as well. We're using the phrase cresting. Global growth is expected to crest. So you talk about the upgrades to earnings estimates. But in terms of global growth, how do you see the biggest risk? Where is the biggest risk? Is it China? Is it Asia? Or is it in developed markets in the US and Europe? This is the world growth forecast, by the way, from the OECD.
the biggest risk that we see to our rather robust expectation for growth actually comes from, well, trade tension potentially ballooning into a full-blown trade war. That is not our base case, but certainly there are non-trivial risk of that. Our in-house indicator points to upside surprise for global growth, specifically looking at G7 diminishing this year in comparison with last year, where for most part of last year we saw upside surprises. And another development this year that is different in comparison with last year is that the leadership for growth is starting to move, or what has already started to move from Europe to back to the US because of greater fiscal package and tax cut, and also emerging market we see greater differentiation as well. So the growth picture is important to recognize that it is less robust in comparison with before, just because of the diminishing upside expectation, but it is stabilizing at a reasonably high level for G7. We're looking at 2.3% growth, which is quite robust, and that should be supportive of risk sentiment if we do not see greater kind of risk coming from the trade side.